Thanks, everyone. Good afternoon. Maybe I would love for this to be more interactive, so maybe I'll pause along the way if folks have questions, but maybe as a sort of room participation, I'm going to be talking about education. Would love to orient myself with the knowledge base that you all have. How many of you, by a show of hands, would say that you sort of follow the education space fairly closely? Okay, so a couple of you guys. All right, great. How much time do I have? 15 minutes for, 15 minutes, and then maybe 15 minutes for Q&A if it's there? Yeah, 5? Okay, all right, great. Maybe I'll weave it in and out if that works. All right, well, I'll give you a brief background. Someone's glasses are here, incidentally. So I'll give you a quick background in SJF and then talk a little bit more about the education space and the market as we see it. Just the background in SJF, we don't have slides, so I'll just talk through it. Our organization's been around 20 years. We just celebrated our 20th anniversary during 2 weeks ago, which is exciting. We're in our fourth fund. First fund was 17 million, second fund was 28 million, third fund was 90 million. Our current fund is 125 million. We are a US-focused return maximizing impact fund. We're focused on a couple of different sectors. One is clean tech and sustainability, so that includes things like energy efficiency, sustainable ag, food safety, reuse, recycling. That's kind of within the clean tech sustainability bucket. We have a second area of health and wellness, a third area of education and employment tech, and that's where I kind of lead our efforts internally for the fund. And then we got a fourth bucket of other for companies that don't fit neatly into one of those other three areas, but have a lot of the investment dynamics that we like with regard to kind of impact and return. We're typically investing in Series A and B financing, so companies that have some critical mass of customers and of users that have kicked the tires, used the product, gone through some renewal cycles. So that's a little bit of a snapshot of SJF. The first fund was a CDFI, the second fund was a CDFI, the third fund was a impact SBIC program, which was, I think we were the first impact program or first national fund through that program. For our third fund, and our current fund has neither of those designations. But we've always been an unlevered fund. So I'm here in New York, and we got office in Durham, San Francisco, and Seattle. So that's kind of the background on SJF. And then within the education space, maybe I'll frame it as the kind of the different buckets within the education space. First, there's sort of early childhood. That's one area. K-12, post-secondary, and then workplace. Those are sort of the four main buckets within the education space. And perhaps not too dissimilar from a lot of venture funds, I think we try to sort of key in on where there's a lot of value in those segments and a lot of pain, and companies that can tap into and extract or benefit from the value and also help to be a painkiller in some of those different areas. We, as part of a side project I organize these quarterly events on education in New York at different thematic topics, but there was one panel maybe end of last year, and we had a panel of other venture investors. So there's about half a dozen or so venture investors that are focused on the education space, and the question I gave to them was, where are you investing and where are you not investing in education? And uniformly, where the momentum was towards was future of work. People familiar with the concept of future of work? All right, so future of work for maybe those, and this is kind of my own definition, maybe it varies a little bit on the edges, is rethinking about how talent is educated and trained, how it is assessed, how it is placed, and then ultimately how it is employed, and thinking about innovative ways to do that. So you think about all the coding boot camps that are now flourishing and really thinking about where there's gaps in training and then delivering that content in a very competency-based way where people can hit the ground running and be employed. Assessment, if you think about the resume, kind of a old arcane system of looking at someone's background. So thinking about new three-dimensional ways to assess someone's talent and skills, that's maybe more meritocratic. Where you throw away the resume and you say, I don't know, there's different ways that companies have gone about it, but we're basically assessing those competencies and mapping them against the skills that are needed for a particular role or employment. And then there's the matching, so finding talent that has historically been underrepresented or not found or latent, and unearthing that and matching it with the employers that are looking to employ that talent. And then there's just innovative ways to employ talent, period. So you think about the gig economy, contract workers, et cetera. those are sort of that's kind of the landscape of future of work. So that I think, and then there was a panel I was on or listened to yesterday by Holland IQ where they took a survey of I think this was global, but they looked at the entire education landscape and they had a heat map. And still, a year forward, the future of work still tends to be the area that's gaining a lot of more of the interest these days. And I think SJF tends to kind of follow that as well. That's an area that we've continuously dug into. Maybe I'll talk about a couple of examples to illustrate and bring it to life. Some other areas, the transitional areas between high school and higher ed and workplace. These are maybe not mutually exclusive with the future of work, but you think about in terms of the value and pain underlying drivers that I mentioned before. When you go from high school and you go to college, probably one of the biggest decisions of someone's life. You're spending a lot of money, a lot of consternation, you're bringing in all of your mentors, your family members. It's a big decision. Likewise, when you migrate from college and you go to the workplace, also a huge decision in someone's life. And if you think about the existing resources, so you think about a guidance counselor today in high school, maybe one guidance counselor for every 400 students, clearly not the most efficient model to help optimize for that huge decision making. And then also that's true on career services. If you think about a traditional university, career services departments typically have not been the most well-resourced and well-staffed, and they generally are not, they're generally failing their students to help them be gainfully employed. So those are two other areas that we've spent some time looking into. So maybe I'll provide some illustrations that I think will bring this to life a little bit. So if you think about future of work, there's been a lot of talk recently. Actually, Guild, which is one of the companies in the future of work, was the newest unicorn. I think they raised about $150 million, and it was over $1 billion valuation. And there the concept is, if you've heard about the Starbucks program with ASU, they're basically letting their baristas or anyone that's worked there part-time enroll at ASU, Arizona State University, and earn a degree at a discounted rate as a way to provide an employee benefit, as a way to retain, as maybe a way to give back. And so they've had, I think, about 3,000 graduates now through that program. And they're not alone. I mean, Walmart has done a good bit in this regard, I think, around college readiness. Amazon has just noted that they're going to be spending, I think, $700 million training 100,000 employees. Whether you work in a warehouse and you want to get trained up in tech to be able to migrate to a higher paying job. So there's a lot of movement towards this. So I think that whole space around helping employers to better train, to better skill, and to link that back to institutions of higher education is an interesting growing space. And so Guild does exactly that. They help organizations in large Fortune 5000s that are trying to help their employees with educational benefits, and they have articulation agreements with higher ed institutions so that can be a seamless process. So that's interesting. There's a lot of employer-based models which we've seen. So yeah, the coding boot camps are kind of interesting. There's obviously a huge dearth of qualified computer scientists, engineers. That's been talked about. That's true in a lot of other industries. In the healthcare industry, that's true in advanced manufacturing or industrial. So there's a lot of different pockets where there's still that sort of supply-demand imbalance. So there's this high level of pain. And so how do you train where you've got underemployment or unemployment? And also, how do you solve this pain point for employers to solve, filling these jobs? And now when you think about the closing of doors on the immigrant population, that's probably more exacerbated when you think of the low unemployment rates. That's even exacerbating further the need for employers to help fill and find these qualified talent. So maybe as one example there was a company for home health aides. So you think about the elderly. There's a shortage of home health aides. And so there are providers that are challenged, right? They have a certain need and they can't solve that market need. So how do you find that? So there was a company that I saw that was, the model was such where they would talk to a home health aid organization that was employing these individuals and would go to them and say, okay, so if we find you talent and we train them, can you guarantee them a job of X? Of $50,000 a year if they maintain certain standards. And so the employer would say, well, sure. And then the organization would go out and post a job saying, we will train you for free. You have to maintain certain standards. We'll train you for free. And on the back end, the employer will guarantee you a job if you maintain those certain standards. and then the company would take a cut of that. So it's sort of this model of providing lower cost education in a variety of different forms, I think is sort of a fascinating new way to innovate around that, to address that cost and the ROI associated with education. Other companies we've seen that are doing that, one's around financial innovation. So there's a company called Vimo, which the college debt challenge is a terrible one. So one of the things that this company has been doing is swapping debt for equity. So you think about universities that have very high results programs, they are willing to provide free tuition if the student that is going through promises a certain percent of their income. If they get a job in that field earning a minimum amount of, say, $50,000, they can make 7% of that income up to a certain threshold. So you immediately reduce the risk around the student debt challenge and you swap it for equity, but it's also a positive market signal that organizations that have high outcomes, high results, high graduation rates are really the ones that are going to do that. And so, if you're a student and you see two options, one debt, one equity, that sort of speaks quite loudly that there's something special around that institution, that they know their standards are so high. And so I think that's sort of an interesting, innovative development around this space. So that's around the training space. I would say the other area which we spend a lot of time looking around is the matching and marketplaces, to think about latent talent and being able to place that talent more efficiently. So the pockets that we spend a lot of time looking into are women, particularly moms. My wife was the head of Pearson's North America business. She was a lawyer, and she's now migrated. We have 2 kids, and she's decided to take some time off. But there is a high level of human capital there. She doesn't want to work full time, but she would love to have a gig job where she maybe works 10 hours a week. And the economy historically has not been conducive to that type of employment. So there's been companies that we've looked at that I think are doing fascinating things around that. There's a company called The Second Shift. There's a company called The Mom Project. So you have this very high, mostly moms, mostly women that have left the workforce, but high sort of talent-based, latent talent. And is there a way to kind of unlock that value? We have not invested in those, but we've spent a good bit of time looking at them. Another one is a company called Jobwell, which is a marketplace for Black, Latino, and Native American professionals. You think about underrepresented populations in the workforce. Those are certainly populations that are underrepresented. So is there a way to kind of unlock the talent around these communities and more seamlessly tie it to the employer base to have them be better represented in the workforce? And then the third pocket that we spend some time looking at is the veteran community. So you imagine all these veterans that are coming off of being enlisted. There's sort of this translation issue that a lot of people will look at somebody who's been in the military for 4 years and not know what to do with that resume. So is there a way to create a translation layer where you can work with employers to help understand that if somebody's had a XYZ role within the military armed forces, how do you translate that into the workforce, and how do you place that talent? So those are some of the areas we spent a good bit of time looking into. Maybe I'll share one other. Yeah, please. Yeah, please.
So I don't think I've heard you mention community colleges.
Yeah.
And yet it sounds like you're circling. Sorry. I don't think I've heard you mention community colleges, and yet all the initiatives you're talking about sound like they could be woven into a community college as an anchor institution within a community. Yeah. Is that
Yeah.
in your universe, in your radar?
Yeah, I mean, career and technical education, a lot of this historically has been done with community colleges. One of the challenges I've seen historically with community colleges, because we work with organizations that are private businesses that are trying to do innovative work, and they would love to partner with a variety of different institutions, whether it's 4-year or 2-year, private, public, for-profit, nonprofit. The one late majority adopter consistently is always the community college systems, for whatever reason. I'm not sure I still understand late majority adopter. So you think about companies that are trying to do innovative work around education and helping these institutions be more efficient and better at what they're doing. So using data to, identify students that might be dropping out before they drop out so you can take corrective action. When you think about that landscape of institutions, the ones that are willing to adopt or think about adopting newer technology are more often than not, the last ones to that party are the community colleges, for whatever reason. Sadly, because they are usually serving those that are most underserved. And I'm not sure, it sounds like an opportunity. Yeah, it is an opportunity. And I think when we find companies that are able to work with community colleges, I think from an impact perspective, there's a band around impact. And if you're serving a student who's wealthy going to a top 20 university, there's some unit of impact associated with that. But if you're doing the same thing and you're helping a community college student, chances are the ability to move impact is greater with helping that population. So I think our eyes are more wide open when we see organizations that are being able to serve community colleges. For sure, it's just that's been a challenging channel for growth oftentimes in the education space. Other questions? Yeah, please.
I thought it was interesting that you called your fund, I think I wrote it down, Return Maximizing Impact Fund. And you also talked about how in the evolution from the first to the last fund, you kind of lost all designations, and now it's just a fund that you call a Return Maximizing Impact Fund. So I'm interested in what that means for you. How does that manifest in terms of the investment criteria? What do you promise your investors? I think we talked about returns a lot today. Do you promise market returns? What does that mean?
Yeah. So on our PPM and what we tell our limited partners is that we are delivering traditional venture returns. And so we are trying to optimize for that. I didn't say in the history that SJF1 was not that. It was not citing market rate returns. This was in '99 when it started, and then the bubble burst in kind of early 2000s. And I think there was a recognition that a below market rate strategy, well, not necessarily specifically earmarking below market rate strategies, but not setting a market rate return, was not going to carry the day. And so I think in the middle of that fund, the two founders said, well, we got to change that up, because then one of them came from a long history of venture investing before that. So that was a change in strategy in that first fund. But ever since then, it really has been to deliver market rate returns for our limited partners. The sectors have slightly kind of changed in terms of crystallizing around sectors of focus. That's evolved a bit. The change or shedding the designation was more of a governance and reporting challenge, not really that it changed anything that we had ever done. We just didn't feel like with SJF4 that we needed the designation to help us close the fund target that we wanted to go after. That was really why we didn't do it, and there was reporting challenges.
If I could observe, as a partner in two of your funds, my understanding was the SBIC was compelling to allow banks to possibly receive CRA credit.
Yeah.
And that your investor base evolved.
That's right, and with CDFI as well. With those first three funds that unlocked investors that would not have otherwise been able to invest. But with SJF4, we didn't feel like we had to go through that in order to raise the target fund size.
Hi, I'm a student here in Columbia Business School. I know you hinted towards future of work and investing in making the workforce more ready and employable. Do you also have an outlook on future of education, and how do you prepare the students who are entering into the school right now for the jobs that would be there 20 years later?
Yeah, I mean, I think and you're talking about post-secondary institutions, so colleges for the most part. Yeah, I mean, I think, the challenge with higher ed is you have to fix the ROI. So it's a numerator and a denominator. You've got to lower the cost so that the return doesn't need to change, but you've improved the numerator denominator. Or you have to, you're happy to pay $100,000 per year to go to college if you can make a certain amount where you can easily pay down that debt or whatever you've had to pay as a result of that. So you got to fix one of those two. And I think there's a bunch of institutions that we've seen are ways to deliver lower cost education. I mean, I think some of these, there's companies we've seen that are thinking about like the gen ed programs, right? Like you're at a 4-year institution and you're paying top dollar for these gen ed programs. And gen ed programs perhaps are not too dissimilar across institutions, roughly speaking. It's really maybe when you get into the more advanced programs where there's greater disparity or differentiation. So can you take gen ed programs at a lower cost institution and be able to transfer those credits, and so you arbitrage the price of that cost of credit at a lower cost institution. That's kind of like one innovative way to make it cheaper. Or you just offer free, like with these institutions that I mentioned before, where they're so confident in the results of their programs that they just say come for free. There's a lot of coding boot camps that do that, and then they take some cut on the back end for that. So, and then there's also, I think there's also a larger question around certain academic institutions are being forced to be more career ready, right? I mean, I think that the institutions at the top of the, the top 20 probably don't have to change because the brand, the graduation rates, the placement rates are phenomenal. And so they probably won't ever really need to change for the foreseeable future. The middle tier of colleges and the lower tier of colleges will, and particularly those that are paying top, where you do have to pay top dollar. And I think those are the ones that are being compelled and forced to move in that direction. And I think it was interesting, one of the speakers yesterday had a crude way of saying, maybe I'll quote what he said. He basically said, if you are a dean of an institution and you have 50 people in your alumni management department and 5 people in your career services department, you should shoot yourself. Meaning, really as an institution, you shouldn't be just thinking about managing and your endowment and raising capital from your alumni group. You really have to be figuring out a way to better serve your students today and sort of think about flipping the resources around that. And I think there's sort of market pressures that are going to continue to be applied to some of, a large swath of those institutions.
Hi, I have 2 questions. So the first question is, in your landscaping, have you come across companies that are working with or would be relevant for specific populations? And for me, in particular, I'm curious about the formerly incarcerated and then also disabled persons. And then my second question relates to revenue models for specifically workforce development related companies. Are there sort of categories of revenue models that seem to work, or are they disproportionately like the corporate is the payor or the customer? So what that looks like. Thanks.
Okay, a couple of questions there. And so on the incarcerated, there are 2 companies that we've seen that we've spoken to over the years, APDS and Adovo, that are trying to work with prison systems to deliver education and reduce recidivism, when people come out of the prison system, to get them gainfully employed, you lower recidivism rates, et cetera. I'm not sure, I can't say that. I don't know well enough either of their 2 businesses more recently to know whether they've flourished or how they're doing, but those are the 2 that come to mind. There's also a company called 70 Million Jobs, which is a marketplace, and maybe that's one I didn't mention before, but it's a marketplace for those that are formerly incarcerated that do have a record, and there are employers who are explicitly saying that they are wanting to employ those that are formerly incarcerated, and so I think it's trying to tap into that. It's called 70 Million Jobs. So those are for the formerly incarcerated, and then the other questions?
The other marginalized group I was thinking of were the disabled persons.
Yeah, we have seen some marketplaces for that as well. I mean, I think there was one more recently, I don't remember the name, but it was individuals on the spectrum of the autism spectrum, and for doing, certain types of works and certain types of roles, similar in the same vein that employers are looking to and eager or have made a endorsement that they will be employing formerly incarcerated. I think some organizations have done the same for those that are disabled. I can dig out the name of that organization, but I think we've seen a couple in that space.
And then the second question was on revenue models.
Yeah. I think one revenue model, which is an interesting one, is a staffing model. So you de-risk. So basically, what it does is it says it finds individuals that are not skilled in a particular area. It says we will skill you up in a particular area, whatever area or field that might be. So whatever, coding. They put you through a 6-month program, and they can and then they will staff you. They'll find an IBM or a Google or an Apple, and they'll staff you out. So Indela is a company that does that. I think they're mostly in West Africa, and they find high talented populations. They train them up, and they staff them out to U.S. organizations here over whatever period of time. And I've seen companies do that in the U.S., and they have a minimum requirement of maybe 6 months. And then after that 6-month period, if the organization likes working with Joe or Jane, they can then hire that individual, and they'll take a placement rate of maybe, 20% of the first year's salary. But that is, that's one interesting one. And then obviously the training piece where they're training for free and then they place and they take that percent of income. I think those are kind of the more interesting models that I've seen.